Welcome back to Practical Pros. Today we are going to cover a very important saving tool, PPF, or is there a better alternative? Let's see. It is so rightly said that we get rich not by our salaries but by our savings. And today we are going to check where can we save best and make maximum returns. To understand how much our savings are giving us, we first need to understand a very important relation between inflation and interest. Now what exactly does this mean? Let's say today I can get this diary for 100 rupees. After a year, because inflation, it becomes 112. I have money today, but I decide to postpone the buying of the diary. I invest it in a very important tool, PPF, Public Provident Fund. I invest the money today. After a year, that money gives me 8% returns to make it 108. What exactly happened? The diary today was costing me 100, after a year cost me 112. PPF investment today is 100, after a year I get 108. This means that actually I'm losing money because today that 100 rupees gets me a diary. After a year that 100 rupees invested does not get me a diary. This means that my interest rate is not beating my inflation and my money is actually getting eroded. In India, in the past 10 years, on an average, the inflation rate has been 12%, whereas PPF has given around 8 to 10%, clearly indicating that the interest that I get in PPF investments does not match my inflation rates. Is there an alternative to this? Let's see. There is something known as equity linked savings schemes, ELSS, which is another alternative to PPF. Now, why does somebody invest in PPF? Because when you file your income tax returns, whatever money you invest in PPF, you get that as a deduction, which means on that money you do not require to pay tax. Let's see, ELSS 2 has that option. It is covered under ATC, whereby whatever you invest in ELSS up to 1,50,000, you do not need to pay tax on that. Both are tax free. However, ELSS becomes tax-free after 3 years. Up to 1,50,000 is a PPF investment. There is no upper limit for ELSS, but under income tax deductions, you can get only up to 1,50,000. Let's see first what exactly is ELSS. It is an option whereby you invest some money in a particular fund and they invest it in equities for you. It is nothing but related to the equity market, hence the name ELSS. Surprisingly, you will see that in the past 5 years, PPF has given about 8.22 returns, but on an average, the ELSS funds has given a massive 17.02% returns. The lowest performing ELSS fund has also given about 13.5% return, clearly way more than what PPF can give you. Is it really that hunky-dory? Honestly, ELSS is way more risky than PPF. Because PPF is of course borne by the government, but ELSS is all related to equity markets. However, more the risks, more the returns. And it cannot be that risky also that you will end up losing all your money for sure. So, next time when you decide to make your investments, get a correct balance between PPF and ELSS. Don't only invest all your eggs in one basket. You split your investments and maximize your returns. If you liked our video, don't forget to subscribe to our channel by hitting the button below.